Hey, what's up everyone? This is Silver Slayer. Thank you for tuning into this video. Gold price forecast twice per century. Signal says depression ahead. Are we going to see the next Great Depression or the Greater Depression or the Greatest Depression? Are weaker times ahead? Definitely, most certainly, we're headed into some murky waters. How severe? We don't know yet. This article is going to talk about what precious metals prices are going to be doing during these times of economic turmoil and how you should be investing. So before we start, make sure to smash that like button. Let's see if this video can get 200 likes. Everyone go hit the like button right now. Thank you so much for the support. Let's jump into it. So a signal has just appeared in the global financial markets, which has only been witnessed one other time in recorded history. And it foretells of immense trouble for the world economy ahead. What is the signal? The gold to silver ratio. It has just shattered its former all-time highs. Specifically, the ratio surged up to 125 ounces of silver required to purchase 1 ounce of gold during the midst of the virus pandemic in March. It has since come back to near 100 as this article is going to the press, but the ratio remains above the previous all-time high resistance zone shown in black. Below, we are showing a quarterly close of the gold to silver ratio dating back to 1940. So, when is the only other time in history that the gold to silver ratio broke out to all-time highs? At the start of the Great Depression in the 1930s. Party like it's 1929. Let's rewind us back to the century in our history books. In the 1920s, the so-called Roaring Twenties were a time of great technological innovation around the world. The widespread adoption of electricity in urban areas, commercial radio broadcasting, and the liquid-fueled rockets are just some of the advances that occurred during the 1920s in which we had lasting impacts on our lives. Of course, throughout the decade, the U.S. stock market rose to reflect these advances in productivity. Yet, by the end of the 1920s, the stock market, which had previously been a gauge of increasing industrial productivity, morphed into a speculative mania. Stocks were bought with little regard to the fundamental health of the underlying companies, and traders sought quick profits in a market which seemingly could not fall. Buying beget more buying, and greed ruled the psychology of the market participants by late 1929. So here comes the crash in 1929. Of course, nothing moves higher in a straight line forever. After the very last of the speculators had been sucked into the bubble, in October 1929, the stock market crashed, falling nearly 48% in the first 2 months alone. 1930 was the worst over. Despite the panic in late 1929, by April of 1930, the stock market had recovered over 50% of its crash, and indeed, many around the world believed that the worst was over. President Herbert Hoover himself is quoted saying in May 1930, "While the crash only took place 6 months ago, I am convinced we have now passed the worst. In continued unity and effort, we shall rapidly recover. There is one certainty, that is prosperity." Let us fast forward the Dow Jones Industrial Average by another 2 years. The worst was over as President Hoover predicted? Clearly not. Clearly, Hoover and others who hoped the worst would be passing by 1930 were painfully wrong. Was there a warning? Was there a warning signal in 1930 that perhaps President Hoover was incorrect and that monumental further losses were in store for the markets? After all, those who sold in the 1930 recovery would have avoided an 84% further collapse in stock prices over the next 2 years. In fact, there was such a warning signal if one paid attention to the gold to silver ratio, or the number of ounces of silver required to purchase 1 ounce of gold was breaking out to an all-time high. So what is the gold to silver ratio in 1929? Well, between 1895 and 1929, the gold to silver ratio oscillated in a range between 17 to 40 ounces of silver required to purchase 1 ounce of gold. Of course, at the time, the U.S. dollar was tied to gold at an exchange rate of over $20 per ounce. Thus, changes in the gold to silver ratio primarily reflected changes in the price of silver. When silver rose in price due to inflation, the ratio compressed lower. Conversely, when silver prices fell due to deflationary conditions, the ratio rose. So, it is important to note that up until this point in time, the ratio had never previously risen above 40 in human history or civilization of humankind. Up until 1929, 40 was a level which always meant that deflationary forces had run their course and that inflation was set to return. The only problem? In 1930, something unprecedented happened. The ratio broke above 40 for the first time ever. And actually, in the 30s, FDR changed the gold to silver ratio from 16 to 1 to 75 to 1. FDR did this. The meaning of the ratio breakout. The gold to silver ratio is like a thermometer for the world's financial health. When the ratio rises, it signifies that silver, which has a dual monetary and industrial role, is losing value relative to gold, which is primarily a monetary precious metal. In other words, when the ratio rises, we are seeing that industrial assets are suffering relative to monetary assets. And when industrial metals suffer, you had better believe that the industry itself is suffering. And that's true. Silver is very tied to how the economy is working. When the wheels of the industry stop turning, price deflation is often the result, as the value of goods and services fall. Yet we must ask, fall relative to what? Relative to money, of course. Remembering that in 1930, gold served as money backing the dollar. What was witnessed in early 1930 by the gold to silver ratio breaking out was a warning that most severe deflation in the history of the United States was about to occur. In other words, the Great Depression was just the beginning. Was the signal a correct warning? You be the judge. Hoover said the worst has passed. Gold to silver ratio breaks out here, negative 84% in 2 years. Back to the present. The same signal which last appeared in the early 1930 at the start of the Great Depression has just appeared again. The gold to silver ratio has, in March 2020, broken out to a new all-time high. To review the chart from the first page again, the only difference is the signal and the one in 1930. Presently, the ratio breaking out above an 80-year consolidation from 1940 to 2020, whereas in 1930 it only broke out above 35-year consolidation. In other words, this time the signal is more ominous than 1930. So that means the prices could be even higher. It could be even a worse of a crash. What was the signal forecasting? Severe deflation ahead. Although we cannot be certain on why it will manifest, it could be that the second wave of the virus to come this fall is going to be much worse than the first wave. It could be that the lockdowns of businesses across the world will be even more severe. It could be something we can't even fathom at this point. Remember, not even the President of the United States was able to correctly foresee that the greatest economic depression in the history of the country was about to start in 1930. However, ultimately, the goal of our work is not to spend hours debating the causes of economic depressions. The goal is to protect ourselves and profit during these times, which is so true. Profiting during the Great Depression. What rose in value amidst the 90% decline in the Dow Jones Industrial Average was kicked off the Great Depression? Gold. In 1933, President Roosevelt outlawed private ownership of gold. He then revalued it 75% higher, in effect devaluing the US dollar by an equal amount. And that's when the gold to silver ratio went from 16 to 1 to 75 to 1. Instead of costing over $20 an ounce of gold, Roosevelt declared it would be now $35 an ounce of gold. That is a handsome 75% return for those individuals who refused to turn in their gold. In violation of the law, according to most historians, few were ever prosecuted. Importantly, that 75% gain was certainly much better than the 50% loss in value in real estate during the Great Depression, or even the most catastrophic 90% loss in stocks during the period. The owner of gold could have scooped an impressive array of assets in the cheap following the 1929-1932 crash. Do not underestimate this signal. The same signal which last appeared in the early 1930s has just appeared for a second time in history of the financial record keeping. The gold to silver ratio has shattered previous all-time highs exactly as it did during the first wave of the Great Depression. Once again, as in the Great Depression, most are convinced the worst is behind us. Yet, the gold to silver ratio is loudly signaling that something is wrong with the quick recovery attempts seen in global markets over the last 2 months. While the world is a vastly different place than it was back in 1930, ratio signals have been a way of cutting through the noise and narratives. Ratios are unemotional data points that simply indicate whether or not industry is suffering or thriving. And in March 2020, the signal spoke loud and clear that the industry is on financial life support. Could stocks fall 84% again from this point as they did in the early 1930s? Perhaps. So let us remember, however, that the US dollar is no longer backed by gold, and so the government needed not to officially revalue gold as it did in 1933. This time, the free market may do that on its own. So, prudent investors should not ignore a twice per century signal which has not appeared since the start of the Great Depression. Prudent investors should own gold. So wow, what a bullish market. What an informational article. You know, this article explained a lot about our history and a lot of what silver prices were acting like during the Great Depression and what could be up ahead of us. Is the worst behind us? A lot of people say yes, but as Hoover explained, he thought so too, but he was very, very wrong, crashing nearly 84% after that. Our stock markets are going to crash. Is gold and silver going to rise? You be the judge. I definitely think gold and silver are the safest, smartest alternative to keeping your money in dollar-pegged things, because if the dollar crashes, then stock markets are going to crash as well. So anyways, I hope you enjoyed this video. If you thought this video was educational, informational, or at least just entertaining, make sure to smash the like button. Let's see if this video can get 200 likes. Go like the video right now. Thanks for tuning in. Make sure you subscribe if you're new. I post daily videos. This was Silver Slayer. I'll see you guys soon. Peace.